Today we're looking at the potential of land partnerships to solve the current credit crash. Just imagine a developer's got unsold homes. Now that might just be the case in Ireland. And a bank on his tail, okay? Who in turn has a central bank on his tail. The technique we apply is this. We take the houses, we transfer them to a custodian. Then we rent the houses affordably, but at an index-linked rental. Because if it's affordable, then hopefully whoever is renting it will see his income rising with inflation over time and will be able to continue to pay affordable rent. Okay? So we rent them affordably, but at an index-linked rental. And we note that because rents are affordable, failure to pay this rental is by definition unlikely. Because if they couldn't pay it, it wasn't affordable, was it? Okay? So then we appoint a manager and we give him a proportional share in the rentals. So he has an interest in doing a good job because he's got a stake in the outcome. Okay? He's not just there on a contract, he's there on a percentage of the flow, as with the Hilton deal. Okay? And the investors complete the picture. We need investors to come in. Now, of course, the developer is an investor. He has put the value of the houses and the land into the pot. So he's an investor. So he's sitting there. The question is, what's he going to get out of it? Now, the occupiers, for them, this is a rent to buy. Because if they pay rent ahead of time, they become investors automatically. They're investing in units by paying ahead of time. Okay? So this is a rent to buy scheme in simple terms. But it gets rid of mortgage slavery because if you don't pay your rent, it doesn't matter provided you've built up a little pot of equity because you can just hand over some equity shares instead. Okay? It's only if you've got zero equity and don't pay your rent, you get thrown out. But that is what happens to tenants every day of the week anyway. Okay? But this is a financing technique that gets rid of mortgage slavery because it's got rid of the mortgage. It also gives us the possibility that by actually doing the maintenance themselves, they can build up sweat equity in the property because, of course, the property has to be maintained. The land doesn't depreciate, but the property does. For investors, it's an index-linked, property-based investment with low risk because affordability equals certainty. Okay? It's a virtuous circle. And it's a perfect match for the liabilities of the pension funds. That's where the investment comes from. Who will buy from these distressed developers the equity shares in this rental pool. Okay? That's where the money comes from. Then they can get around to repaying the distressed banks and make the central bank happy. Okay? Let's have a quick look at the numbers. Now imagine a pool of 1,000 homes with outstanding debt of 200 million euros. Conventional mortgage finance, assuming that they've all got a 25-year loan at 6%. Now I don't know what the rate is here at the moment, but at 6%, we're talking about a bill, and this is interest and capital repayment, of 15.6 million a year for 25 years. Let's look at it from the other end of the telescope. First thing we do, we create the pool. We put the houses into trust, well, trust is the wrong word, into the hands of a custodian, and we set an affordable rent. Let's say 6,000 euros. It could be higher, but then we just change the spreadsheet. But we say 6,000 euros. If we say 6,000 euros, and don't forget we were looking at 15,600 euros before, the rental pool is then 6 million euros in the first year. Then what we do, we unitize. We just divide it into nths. Okay? It could be 1,000,000, it could be 1,000,000,000, it could be 1,000. It just, proportional shares just, you get it into the right bite-sized chunks. And what we've created then, possibly, is 1,000,000 equity shares, millionths, each carry to the right to €6 initially. But it will rise then, or fall, depends, with inflation. Then we sell them to investors. It's a very simple calculation now. It all depends what rate of return they want or they demand. A market will develop in these things. But don't forget they're low risk. At 3%, we can raise 200 million, because 3% of 200 million is the 6 million that we get, okay? That actually pays 100 pence in the pound. Remarkable, isn't it? At 4%, we raise 150 million, and that repays 75% of the debt. At 2%, in fact, we would raise even more than the debt, so there would even be a return to the developer. Not that anybody here would think they might deserve that, but who knows? There may be developers here. So, you know, they've been taking the risk themselves. But the point is, this is a way of refinancing debt. And the why it scores is you're not, in a 25-year loan, you're repaying on average 4% per year. Okay? That's what we're taking out of the equation. And secondly, because it's index linked, we're not looking at 6%, we're looking at 2 or 3, but something less than 6%. So that is existing property. That's a pool of built properties, no development to do. Let's have a run through undeveloped land.